Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at multi-sensor AI holdings, or as we'll call it, MSAI.
If you find our talks useful, please consider subscribing, liking, and commenting underneath. It really helps support what we do. And if there's any stock you want us to look into, just, leave it in the comment section below.
Of MSAI. We're looking at a company that, it truly faced a near-death experience this fall.
It really did.
Only to stage this really dramatic multi-million-dollar recovery right before a critical operational deadline.
That's a perfect way to frame it. Before we even get into the AI potential or anything like that, we have to start with the emergency room report, right?
Absolutely.
If you look at the Q3 2025 financial snapshot, specifically through September 30th, the alarm bells were just ringing so loudly.
Oh, they were deafening. Their cash and cash equivalents had absolutely plummeted. They were down to just a hair over $1 million, $1.064 million to be exact. Wow. Yeah. And that's a drastic drop from the, $4.3 million they had earlier in the year?
Yeah.
For a high-growth tech company, that is.
Yeah.
It's dangerously close to the line.
That is just a classic indicator of severe cash burn.
And that burn is reflected in their historical performance too, right? Because they have this huge lingering shadow over the balance sheet.
They do. It's a massive accumulated deficit. We're talking over $64 million.
$64 million.
And what this number tells you, the listener, is that despite operating for some time, the company has consistently lost money as it invested, and invested heavily in growth and tech development.
Sure, which isn't totally unusual for a tech scale-up. But
right. But you combine that deficit with that $1 million cash balance.
Yeah.
It created an immediate and very urgent question about their financial runway. They were running out of time, plain and simple.
Okay, let's unpack this then, because this is where the story gets really interesting. It becomes less about those historical losses and way more about immediate market confidence.
Mm-hmm. Recognizing this, existential capital challenge, management pulled off one of the most aggressive and, frankly, successful capital-raising sprints we've seen in a while.
It was a tour de force.
They went to the market and generated over $27 million in gross proceeds in just October and November.
And they did it in two distinct rounds, almost back-to-back. First, there was an initial private placement that was designed to bring in major long-term institutional money.
Right, the strategic investors.
Exactly. That was targeted at $14 million, though only a partial closing secured about $2.85 million up front. The bulk of that money was placed into escrow until, certain conditions are met.
And then almost immediately after, they followed up with a registered direct offering. For those who might not be familiar with the mechanics of financing, why that route? What did that change?
That's an excellent point.
Mm-hmm.
A registered direct offering is, it's essentially selling new shares directly to institutional investors, but quickly. You get to skip the complexity and time needed for a full roadshow.
So it's the fast cash.
It's the fast cash. They placed 4.595 million shares at $1.35 per share. That netted them approximately $13.6 million right away. So you have the combination of the two, the slow strategic money in escrow, and the fast, immediate cash.
And that gave them the $27 million lifeline.
That's the one.
That quick succession of raises, especially placing shares above $1 when the stock was under so much pressure, it suggests the market didn't see their Q3 situation as some kind of fundamental failure.
No, it saw it as a temporary liquidity squeeze. And that institutional support is key. It's more than just support. It's a massive vote of confidence.
You're talking about the insider buying.
Exactly. Look at the insider acquisition activity that happened right around the private placement in October. You had entities associated with 325 Capital acquiring shares and warrants at that specific valuation.
So when the big players dive in at a negotiated premium price like that,
it signals they believe the future strategy is sound and that the Q3 cash crisis was, an anomaly, not the new normal.
But, okay, none of those financial rescues matter unless the core product is sound. So let's shift gears from the checkbook to the tech stack. What exactly did those institutions buy into? Because the underlying business strength actually seems pretty impressive.
It is. The financial stress really hides a very robust operational metric. Their gross margin. Multi-sensor AI boasts an incredible gross margin of 60.7%.
60.7%, that's huge.
That is a margin that would make most enterprise software companies extremely jealous. And it sits well above the industry average for hardware link tech.
Okay, so help me connect the dots here. If the margin is over 60%, why is that accumulated deficit of $64 million dollars so massive? That feels contradictory. Is that just R&D spending or is it mismanagement?
And that's the critical question you have to ask when you're analyzing this stock.
Hmm.
The company's narrative, their story, is that the high margin proves their pricing power, but the deficit proves they are pouring every single penny, and then some, into growth, R&D, and expansion. It's an investment strategy. And speaking of strategy, they've made a really pivotal move, shifting to a hardware-agnostic AI platform.
Okay, that phrase hardware agnostic, it sounds technical, but it seems really crucial for their future. What does that actually mean in practical terms?
In simple terms, it means they are no longer tied to one specific piece of hardware. Historically, their AI might have depended on, say, brand A's sensors or brand B's IoT devices.
Love it.
By becoming agnostic, their MSAI Connect platform can integrate with, well, virtually any existing infrastructure. This immediately opens up a dramatically broader addressable market.
So they're selling the intelligence, the software, not the physical device.
Exactly. They're not hampered by the lifespan or the development cycle of some specific expensive piece of equipment. It's about monetizing the data, regardless of where it comes from.
That makes the revenue growth context much clearer. They reported, what, $7.4 million in Q2 2025 revenue, and that was driven by expanding demand and a major new distributor partnership. So it sounds like the strategy is working on the sales side.
Sales are accelerating, yes, but we have to keep that balance. Even with $7.4 million in revenue, they still posted a net loss exceeding $3.3 million in Q2.
Whoa.
And management attributes this to upfront scaling cost-hiring sales teams, expanding that distribution partnership, heavy R&D for the new platform.
Which, that narrative makes sense for a company trying to scale rapidly, but sustained losses of that magnitude mean execution on tightening cost controls has to be vital. They can't just keep justifying $3 million plus in losses every quarter just because they raised a bunch of capital.
Exactly. The clock is ticking on proving that those investments are generating recurring, sticky revenue, particularly SaaS revenue, which is a higher multiple business model they're aiming for.
And this brings us to the most critical, the most imminent near-term event that really dictates whether they can continue this expansion.
The shareholder vote.
The shareholder approval vote, scheduled for November 24th.
That date is essentially the cash and lock event for the company. Remember that initial private placement money we talked about?
The part that's in escrow.
Right. $11.15 million of that is currently held in escrow. This vote determines whether the shareholders approve releasing that tranche. If it's approved, that capital is immediately injected into the company.
Which would then accelerate all those SaaS initiatives we were just talking about.
And provide a much-needed extension to their financial runway. A failure to pass that vote would be catastrophic. It would imply a massive loss of faith. It would severely limit their ability to execute the new strategy.
And they'd likely have to raise capital again, but under far less favorable terms.
It's a make-or-break vote. But even with that potential cash injection, they are fighting a separate structural battle that investors just cannot ignore, maintaining their Nasdaq compliance.
Yeah, this is a massive risk that needs more context. We saw they briefly got over the $1 minimum bid price for 10 days in November, which was a necessary milestone, but then the price just fell right back.
It did. And while they satisfied that little interim requirement, Nasdaq just granted them a 180-day extension until May 11th, 2026 to regain sustained compliance. This is a critical operational priority because delisting it's just highly detrimental.
Explain that for a second. Why is delisting so critical for a company that just successfully raised $27 million? Doesn't the money solve that problem?
Not entirely. Delisting moves a stock to over-the-counter or the pink sheets. That immediately restricts which institutions and which retail platforms can even trade the stock.
So liquidity dries up.
It destroys liquidity, it often drives the price down even further, and it sends this huge negative signal about the company's stability and governance. It essentially eliminates institutional participation.
The very people they just spent all that effort courting with the $27 million raise.
Precisely. They have to maintain a price above $1 for a sustained period before May 2026. Or this entire rescue mission is severely undermined.
Okay, let's turn the lens now from risk management to the growth opportunity, because the technical and analyst picture, it paints a completely different story, one of pretty explosive upside potential.
The street consensus has become incredibly aggressive. Analysts are raising their 12-month price targets to a range between, say, $2.30 and $3.
And considering the stock has been trading around 85 cents.
We are talking about a forecasted upside of 170 to 210%.
Huh.
This isn't some modest forecast. It's a projection based on the expectation of successful scaling and realizing that high growth margin leverage.
That's a strong fundamental story built into those numbers.
Yeah.
But when we look at the technical setup, there's an immediate, almost explosive potential catalyst just waiting for any good news.
And that is the short interest. It is huge. MSAI has a remarkably high short interest sitting at 30.8%.
30%.
To put that into perspective for you, roughly 1 out of every 3 shares traded is being held by a bearish investor betting the price will fall.
So what happens when you combine that much short interest with a positive catalyst, like a successful shareholder vote or a massive partnership announcement?
You get a short squeeze scenario. Because the stock is currently trading above its 50-day moving average, any sustained upward movement forces those short sellers to quickly buy back shares to limit their losses.
And that forced buying just pours fuel on the fire.
It drives the price up exponentially faster than normal buying volume. It creates enormous volatility and could potentially overshoot even those already bullish analyst targets.
Yeah.
It turns the stock into a volatility bomb that's just primed to go off.
That high short interest really tells the story of how polarized the market is. You have institutions validating the company with $27 million on one side.
And on the other, you have massive short sellers betting the whole thing implodes. It creates a very high-stakes asymmetric risk-reward scenario. The upside is explosive. The downside involves failure to execute and that delisting risk.
And beyond the mechanics and the technicals, we are starting to see some market rumors, right? Some speculative catalysts that could drive future growth and fuel that short squeeze even more.
Yeah, the primary speculation really revolves around potential strategic partnership announcements. Integrating the MSAI Connect platform with major enterprise software providers is the key here.
They need that distribution reach.
They do. And partnering with a large software ecosystem would provide instant access to thousands of enterprise customers. That would be immediate revenue validation.
And what about the big picture rumors, the M&A chatter?
We've heard some unverified rumors, whispers really, about potential M&A interest from a larger AI conglomerate that's looking to quickly acquire best-in-class sensor intelligence. Now, if those rumors were substantiated,
The current share price would be irrelevant.
totally irrelevant. The company would likely receive a significant premium for a takeover.
So all those factors, the short interest, the institutional cash, the analyst targets, the M&A rumors, they create that strong asymmetric upside picture that investors love to see.
They do, but we need to summarize the core thesis here and conclude with a final risk check. Multi-sensor AI is absolutely at a critical operational inflection point right now. They successfully secured over $27 million in fresh capital, but that was just the start of the race, not the finish line.
So success now hinges squarely on 3 key operational factors. Number 1, that shareholder approval of the $11 million escrowed capital in the upcoming vote.
Number 2, maintaining Nasdaq compliance until May 2026. This cannot be ignored.
And number 3, and this is the big one, demonstrating tangible, accelerating progress on converting that high gross margin into repeatable SaaS revenue to justify the investment and finally extend that financial runway comfortably beyond 2026.
The key risk remains the execution risk. It's about scaling those new distribution channels while managing the sustained operational losses. It's a binary, high-stakes trade.
So considering that highly bullish analyst targets and that massive successful capital raise, the question you really need to ask yourself is this. Does the potential for a short squeeze, combined with a successful November 24th shareholder vote, make this a compelling short-term catalyst play? Or does that lingering $64 million deficit and the Nasdaq deadline demand a longer wait-and-see approach, where you wait for proven SaaS revenue before you even think about jumping in?
An excellent thought to chew on as you review your own strategy. We appreciate you tuning in. Be sure to subscribe so you don't miss tomorrow's analysis.